Hello, everybody, and welcome to the Trading with Ashley show. When you run a trading community, you get certain questions more often than others. And one of those questions is something that this video is all about. It is, what do I do when I have a covered call on one of my positions and it has blown past my strike price? How do I repair that trade? So I thought I would dedicate a video to how to avoid getting into that situation to begin with, and then some things you can do to repair the trade. So this is going to be full of great information, and you will more than likely want to refer back to this over and over again as you find yourself in that situation. And it's really a good problem to have because that means that the market is surging. That means that you selected great stocks that are continuing to grow. So we're going to talk through those dynamics. But before we get into all of those details, I wanted to just give you a little PSA right now. We are now a few weeks into the Buy Right Challenge, and our members are thriving. I'm so excited for them. If they had taken every one of my trades with the exits and the entries that I have been calling, they are now almost $2,000 richer off of a $30,000 account. Here are what a few of our new members have to share. So Falcon joined us on July 17th, and as of the 30th, just 10 days in the Buy Right Challenge, he's up almost $5,000 in one account, $1,100 in another account, for a total of $6,000. Now, he went on to share that he's grateful to be a part of this group, that it has delivered as preached. He said, "My previous doubts have melted away. Ashley delivered, and the community has been very supportive and helpful. My hat's off to you all." And new member Cliff, who joined us on July 10th, he is already up in several accounts. One of them 6.6%, the other 7.9%, 28%, and 32%. And he said, yes, that is monthly performance, not year to date. He says he's extremely pleased with the results and even more grateful to be a part of the community. And the best part is they're not just taking the signals and that's the end of it. They are learning so many different ways to trade. We are not only doing the buy right, but I am peppering in some credit spreads. I have helped them with swing trading, and they are learning how to handle it when a trade works against you. We had one trade that we took a small loss on, and I pivoted to a completely different stock to make it up and then some. So if you want to learn with us, we actually will be going all the way through August with this Buy Right Challenge. There's no time like the present. Go ahead and click the link below if you want to join all the activity in the Buy Right Challenge. I promise you, you are going to get a lot more than just some trade signals. You are going to learn how to do this for yourself. And that is what my entire platform is about. It's about teaching you the independence of trading and everything that comes with it. So first, when we are talking about covered calls, let's talk about prevention first, because this will help you not get into this situation to begin with. There's actually specific things that I do so that I don't find myself in trouble with a covered call. So let me explain to you what those are. The first thing is I have two completely different accounts. I have my buy and hold account, which has all of my legacy stocks in it. I do not sell covered calls on those shares. I let them run free. In fact, if we have pull downs or pull backs, I just add to that position. That leaves me free to run the wheel strategy on all of these stocks in my trading account. So I may have shares of Robinhood, Palantir, Nvidia in my buy and hold account. Those run free. But then I like to trade those same stocks in my wheel account because they offer great premium. And I don't mind so much if I have a call away on my wheel account because I know I have my buy and hold account that is running free. So that's the first thing. You want to separate your trades and leave your buy and holds free. Don't sell covered calls on those. And then in your trading account, sell covered calls on those. But that brings me to my second point. When do you sell covered calls? Actually, it's not a good idea to go ahead and just start selling covered calls the minute you acquire a stock. I like to wait to sell covered calls on my positions until I see that RSI on the 3-month chart is close to 70 or maybe right at 70 or above. And I like for my stock to be trading in the upper half of its Bollinger Band. It's usually a very fair call away if you shoot for right at the top or right above the band. The other thing is I do not go out more than 1 week when I am selling covered calls. Well, why is that? Yes, I know you'll be enamored by large premiums if you go out, let's say 2 or 3 months. But do you realize you are stuck in that trade if the stock does not pull back? So if a stock continues to surge over the next few months and you have a call that's out 3 months, you cannot rinse and repeat with those funds that are holding the trade. You're just stuck. So for that reason, I don't do it. I like to only go 1 week out. That allows me ample time to either buy back the call if I decide to do that, or at least I can roll without going out too far. So if you have followed those rules and it has blown past your strike price, I want you to fully understand what you're looking at in your broker's account. So when you have a stock that you have sold a covered call on, and that stock rises from the time that you sold the covered call, you will notice on the position in your broker's account, it is red and it will show you a negative number. But I want you to be fully aware of what you're actually looking at. You're not actually losing that money. They are just showing you what you could have had if you had waited to sell that covered call at this moment in time. And so a lot of traders panic when they see that red, but as long as you are selling covered calls above the amount that you paid for the stock, or if you were put the shares, if you're selling above that, you cannot lose money. But if you see that red and you panic and you buy back that covered call, then that is a realized loss. So if that situation presents itself, just try to determine if you think that the stock will eventually come down below the callaway price, and then you can just reacquire your shares. So you would let the callaway happen and then just set you a buy order below your callaway to reaccumulate your shares. That's my favorite way to handle when it has blown past my strike price. The other thing you may want to consider is rolling the position. Now, if you have only gone out a week or at the most 2, you usually can roll up past the current price action. And let me tell you why I like rolling out and up past the current price action. If I do that, then that leaves me free to reaccumulate the shares before my callaway happens. Let's say, for instance, on Robinhood, let's say you had to roll your position out and you rolled it up to $110 a share for the callaway. Well, you have between now and Robinhood rising to $110 to go ahead and reaccumulate your shares. That way, if your shares are called away at 110, you regained them, let's say at 105. So I will roll out one time higher than the current price action, so that buys me a little bit of time to regain my shares by purchasing them again below the callaway. Now, if that won't work for you because you don't have the additional funds to repurchase your shares until that callaway is happened, then what I like to do in that situation is sometimes I will buy back the covered call, and then it's called a delayed roll because I will not sell a new call on it until the price movement has moved up to compensate me for the loss I took buying at that. So let's say in that Robinhood situation that I buy back a $100 covered call and I had to pay $500 to do that. In that situation, I will not sell another call until Robinhood has risen another $5 in value, that the price appreciation will actually pay me back for having to buy back that covered call. Then once it rises that $5 to pay me back, then I will at that point consider selling new covered calls at a higher level. If I just roll the position, then I'm locked into whatever the trade's offering me, and a lot of times that is not the best situation for me. And the last tip that I have for you when it comes to covered calls is something I have been doing with the Buy Right Challenge. So if we're really bullish on a stock and we think that it's going to be called away, I will at times when I make the initial 100 share purchase, I will buy maybe an extra 25 shares that of course I won't be able to sell covered calls on because you need 100 shares, lots of 100 to sell covered calls. So those extra 25 shares will be free to continue to run if I have a call away of my 100 shares. And that has given us extra amount of cash to work with when we have our shares called away. So I hope all of this was helpful. I hope this opens up your mind to a new way of thinking when it comes to using the wheel strategy to grow your income. Remember, if you're with me, Trading with Ashley, there is no trader left behind. Now, I had made another video on the art of selling covered calls, and I will go ahead and leave that video for you right here.